Hello, everyone in Bankland. This is Brian Love, head of Banking and Fintech at Travillian. So excited to have one of my favorite guests join Andrew Liesch and I on a little hot take episode of Travillian Next. We are talking today with the head of Depository Markets and Strategy at Piper Sandler, Mr. Scott Hildenbrand. How are you?
Hey, good morning, Brian. Thanks for having me back on. And Andrew, good to see you as well, bud.
Likewise, good to see you.
Yeah, we didn't prep at all for this. The way that we want to stump you. We want to, get the greatest, freshest thoughts out of your noggin there, Scott. I'll turn it over to Andrew after this question. I wanted to hear, I know you're in board meetings all the time in front of boards. What are you hearing? What are you hearing in the first quarter of 2026 here?
Yeah. So I'd say per usual, nothing's really played out exactly how the boards and banks thought it would, right? Let's start with that. And I'd say in the boardrooms, there's probably a touch of frustration for publicly traded banks still. And Andrew, your old hat, you'll appreciate, in terms of the disconnect still between earnings and valuation, right? Earnings are solid. They're really good. Historically, looking at, margins and EPS growth, ROE, all the numbers we could all have fun discussing, but they still trade 10 times earnings and not even 130% of tangible book. It's just not, it's disconnected. So I think there's a frustration, Brian, which leads to a lot of education and discussion around what's the dynamic and the reasons for that. I think a lot of that though is a waste of time, in my own opinion. I think what really matters is taking advantage of what's gone on over the last, let's call it even 2 weeks, right? And I always think about the dynamic between boards and banks. And one of the best things I can say about the best run boards is that they lead board meetings with an order to get some execution done, right? The best strategy is execution. It's not the plan. And the plan is important, but I think execution matters. I think that the word, and Brian, you and I have talked about this over the years, the word when. It's not how. Every bank I work with knows what to do with interest rate risk and with balance sheet management. It's just when. When do I put the strategy in place? How do I execute? How do I educate my board to get authority to do it? And so we're spending a lot of time there. And I'd say the third thing we're doing is we're educating boards on WARSH, the nomination of WARSH. What does it mean for my institution? What are the couple of scenarios, if I'm the CEO, that I need to have in my back pocket ready to go in terms of, we see the curve steepen. What does that do to us? Do we see the curve steepen because the short end goes down faster than expected? Or more importantly, are we actually now, with all of the movements going on with Iran and everything else, now are we thinking about the belly higher and the short end here? And what does that mean for the market value of my company versus the earnings stream of the company? And there's going to be a disconnect and there's going to be a board confusion. Mark my words on this over the next 3 months. So I'd say those are probably those three key topics, along with everybody's favorite, which is, M&A. The tidal wave was supposed to happen. It started to happen late last year. I'd say we're on a slightly slower pace than I think a lot of people thought. Some of that to do with the war, rate volatility, private credit, AI, you name it, we can throw it. You can just blame anything on AI, I think. I'm allowed to, right? The fact I'm getting older, I just blame it on AI. But I think that there's always that dynamic in the boardrooms as well on the M&A front. And capital markets still wide open, Brian. The debt market is still seeing a lot of refis from debt that was issued 4 years ago. So we're seeing a tremendous amount of interest there in bank land to go out and issue debt, either to replace or to bolster capital and continue to try to optimize the balance sheet with growth and restructuring. So a lot going on in our world, a lot of fun, and every week is something different in this administration, which keeps me on my toes, which is also a lot of fun.
Well, let's dive into a couple more of those issues, Andrew.
Yeah, you mentioned the word when you're talking to the management teams and the boards that you have the most respect for today, the ones that are the highest performers. What are they doing now? What is their when as it's now?
Yep. And I think, Andrew, that's a great question. I think the best run financial institutions, the best banks in the country, have already received authority to transact on small, thoughtful restructuring transactions based on 10, 15, and 20 basis points shifts in the yield curve. This is a wonderful opportunity right now. And unfortunately, not enough banks are taking advantage of Iran war and rates go higher. What are we talking about, right? When was the last time that disconnect happened? While others want to talk about it, the best run financial institutions are putting things to work, whether they're buying assets because spreads have widened, right? Whether they're thinking about the yield curve risk in a different format. There's a lot folks can do, and it all comes to preparation, right? When Warsh was nominated, forget the Iran war. When Warsh was nominated, we would go into boardrooms and I'd say, you need to have two scenarios, the worst scenario and the Trump fake, right? And those are the two scenarios that we should have ready to go. And the Warsh nomination led me to say, we got to get really focused on what we can put in place when we see the belly, kind of that 3 to 5 year area and higher increase and the short end stay flat. What are we going to do? How do we take advantage? And do we have issues? So, Andrew, I'd say every bank is a little bit different with their yield curve risk, but my gosh, 20 basis point moves and they don't lead to transactions. That's what's frustrating for me when I work with financial institutions, because as I said to Brian earlier, the best strategy is execution. And you can't do execution without understanding and measuring who you are today and what those two scenarios at a big picture I just mentioned, what the impact is on your earnings, your liquidity, your interest rate risk, and your capital position. And that's what we discuss in boardrooms and with management teams.
That execution piece that we hear, we've had some really amazing CEOs on the podcast, like Mark Triniski up at Community Banks. It's now Dimitar running that bank.
Yep.
He talked about seamless execution. Johnny Allison, John Corbett, they all use those words. And, those are banks that are, admired greatly. Andrew, go ahead.
Yeah, no, I'm just curious. Like, so that was like maybe the positive side of what they're doing now. But what do you see most banks that are doing wrong? What are they really going to regret in a few years?
Yeah, I would say the regret side of this is waiting for these volatile times to then decide what to do, right? The defensive approach when the markets are going a little haywire is backwards to me. This is the time that I trust my treasurer, my chief financial officer to go execute transactions that can get us into a better place. I have heard for the last 18 months, spreads are too tight on every asset. Well, we just had a widening. Guess what? We're still not seeing a ton of folks jumping back in and thinking about how to get assets in play at wider spreads, right? There's little things like that, Andrew, for me that I think a lot about. And the other part of this is if I haven't educated my board on the hedging world, I'm going to be way behind in managing a quick moving rate environment and a much faster, more athletic balance sheet that I have today versus 5-10 years ago. We talk a lot about this on the liability side of the balance sheet. It's very difficult to get term maturities on the balance sheet, right? And is the most we typically can get is about a year. I heavily focus on when we see a rally in rates, when we see a curve flattening, how do I get long-term duration on the liability side to allow my asset side some freedom to do what it needs to do? And I think that too many institutions today will kick themselves because they focus on a siloed approach of either the assets or the liabilities. And Andrew, you've heard me probably say this a million times. We are spread managers at our core. I'm agnostic to which side of the balance sheet I'm focused on because I'm focused on the spread and which side needs the tweaking and which side needs to play offense. There's always going to be one or the other. And I think sometimes when we split the baby, you make big mistakes because you double down on the siloed approach. And so the worst run institutions, or not the ones that Brian mentioned, or not trading where they want to trade, there's typically a correlation with lack of execution and a true lack of understanding of spread management versus making market calls.
You mentioned the importance of the CFO, the controller, and those roles have to be much more much more thinkers now that I think than ever. So that's a perfect segue into Brian's question over on talent. Go ahead, Brian.
Well, I mean, in the boardroom, actually, let's start there. Because there's an influx of conversation we're having with banks that are searching for better balance sheet understanding on their board, ALCO understanding, and also technology, but that's a whole other conversation. Right. And again, I'll ask this directly. It's up to you if you want to answer it. Are there any banks that have board composures that you admire, and why?
Yeah. Yes, I would absolutely say yes. And I will tell you though, Brian, it goes to a little bit of what Andrew was saying. I typically view the best boards based on the fact that management is incredibly transparent and proactive. I will never name a name on the negative front, and even on the positive front. I really shouldn't. But what I will tell you, what I will tell you is I've been in board meetings where the CEO, he or she has pulled me aside and said, don't hit this topic, don't hit this topic, and don't hit this topic. The reverse is good CFOs never hear no in the boardroom. Great ones always do. If you are not pushing the envelope with your board around education and strategies and hearing no, you got a problem. Because as good and as intelligent as bank board members are, the intelligence is high, the experience around spread management is low. And so the first 3 times management comes to educate the board on the worst nomination, right? The yield curve steepening, receive fixed swaps I should put on, or leverage transactions I should put on, you should hear no. But a lot of times, Brian, I will hear from management, I don't want to go down that path with the board. It'll open up a whole nother can of worms. And I'm tired of hearing that, because we are now at a point in our industry where I believe that the biggest challenge outside of when in strategy is the disconnect between board and management around direction of strategy. Transparent. What, if you asked a board member, what would define success for us in 2026? And then you ask the management team that, I'd guess 30% of the time I'd get a consistent answer.
Wow. I'll take the under on that, maybe.
So I guess I just solidified I'll never be asked to be on a board, but that's okay. I get in trouble in a lot of rooms, but it's what I see and how I feel as I travel the country.
Well, so, and we will talk a little bit about M&A and how that relates to talent too, but I want to ask you a question. So let's just say you were the CFO or CEO at one of these community banks.
Yeah.
And you were hiring a head of balance sheet strategy. So what skill set would you insist on that maybe wasn't required a decade ago?
Yeah. I would say a couple of things. I would say, and this is a serious one, and you're going to chuckle a little bit. The first thing is leave your ego at home. What I have seen is egos and insecurities destroy strategy all the time. You want to know why? A lot of folks are a lot like my high school basketball career, and I'm not afraid to admit it. I played in college Division III, nothing great. I wasn't that good, but in high school, I will admit to you that I cared more about scoring the most points in the game than winning sometimes. I see that often. It's embarrassing, but it's true. I learned a lot through that process. But I see it a lot in alco rooms where people almost have tunnel vision to, I told you I was right and I predicted this. And it's so much less about predicting and so much more about preparing. You can prepare for multiple scenarios. The insecurity needs to be checked. And I would tell you this, I would want to work with someone that plays Monday morning quarterback and delivers to the board on a quarterly basis. Here's the 3 things I did right and the 3 things I did wrong this past 90 days within balance sheet management. And the 3 things I did wrong, here's what we collectively are going to learn from as a board member, as a management member, and as head of strategy. And so I try to apply that into my career with my teams and all of that. But I think that's a huge lesson here because, Brian, with all the technology and all the information flow around strategy, the how is not our problem, as I said earlier. The when and the development and putting your insecurity away. It's not about being right early, right? It's about preparing her.
So I'm hearing those skills, those traits around self-awareness and communication.
Oh.
It's got to be people who can communicate complex issues sometimes to people that,
the bigger one I would say. Yeah, the bigger one I would say is I want everyone in college, they should have to take a public speaking course. Because where I have seen great strategies go to die is an incredibly intelligent person who doesn't know how to communicate in 2 to 3 slides at most to the board. This is the purpose. This is why we're doing it. And this is how I'm going to execute it. We don't get there because it's just spinning around in circles. And so command of a room and delivering something transparently and in a way that it's understandable is a skill set that will take you very far in your life, no matter if you're banking or anywhere else.
Yeah. Yeah, I agree. It's persuasiveness too.
Yeah.
Perhaps in there. There's a salesmanship to being able to address people and getting them to understand and buy in. That's great. And is there any hard skills? Like, I mean, obviously liquidity, understanding of interest rate risk and FP&A. Is there anything very specific else that you would add to that?
I also look for competitiveness. That may be a soft skill, but I'll tell you how it translates to a hard skill.
Sure.
I travel around, you'll chuckle, and Andrew, you'll definitely chuckle. I walk into a lot of rooms and banks love to show me their peer group, right? And I say, oh, we're comparing ourselves to the 10 banks that live down the street that have an ROA within 3 basis points of us. That doesn't do any good for me. Show me the highest valued banks in the country on a multiple basis and show me why we're different and how we can build a way to get ourselves into that group. And I'm not going to stop from a strategic perspective until I am in that group. And so for me, from a strategic perspective, you can get very granular. And I'm not afraid to say we are not in the best group right now. How do we get here? Putting a map and a plan in place to say these are the 5 things from a strategic perspective we got to execute that I believe can get us into the highly valued group. That is, to me, a big change, right? Because for years and years, we kind of stumbled through, well, as long as the bank's near us, we kind of look like them. We're okay. I'm out on all that. I want to be the best, and I'm not. And we got to work harder at being the best. And if you're not, then how can we get there? And I don't want to hear people don't understand my story. People don't understand you when you tell your story. There's a difference.
Also, I mean, just emulating your neighbor isn't good enough. It's the strategy, to execute better than your neighbor, I guess. Yeah. That's what you're saying.
Yeah. And how to adapt. I think the best run banks also make big changes when they're in that group, when they are the highly valued. We say in the capital markets world all the time, you raise capital when you're strong. That's the best time to do it. It's also the best time to adapt and make changes and say, wait a minute, over the last 3 years, my deposit base has started to change from a demographic perspective. What are we doing from a marketing perspective to attack that? Because this is changing and we're not the same institution we were 5-10 years ago.
Yeah. We are building the most epic job description during this conversation. Some bank is going to be just feverishly taking notes and wanting to hire this unicorn. Yeah. So the next category is M&A. You was always talking about it since I've started 10 years ago. I've been posting M&A on LinkedIn, and it's like my thing. I want to bring Andrew into this dialogue as well. I guess maybe the first point is a riff off of talent. How is M&A affecting the talent market? And obviously, I know I can answer this question a million times in a million different ways, but you had an interesting take about obviously how the talent markets are going to get replenished by M&A. What are some other thoughts on this topic?
Yeah, no, I'd say one of the best opportunities, right? And it's ironic in a way, Brian, but one of the things, and Andrew and you have heard and talked about and seen for years, right? And I am a believer in it, is scale matters, right? Scale matters in our world where we're living on smaller and smaller spreads historically. So we need more scale to invest in tech and infrastructure and talent, right? Those are the things we think about. But what's interesting for me is I want to think about right now is if I'm like an $800 million community bank, I am so fired up right now for all the M&A that's going to happen. And I'm going to go have dinner with the best lenders, maybe a chief financial officer of a highly valued company I admire where I'm going. What a wonderful opportunity from a dislocation perspective to go get real talent that have done things like an M&A deal, raised capital, done a large restructuring, gone public, dealt with a regulatory reform. This is a huge opportunity because a lot like real estate, and they talk a lot about real estate. I grew up in Philadelphia and I love to go down to Avalon. Avalon's like my favorite place in the world. And everybody always tells me they're not making any more land there, right? Well, in my opinion, it's the same concept with the bank world. When I started, there was 8,000 some banks. Now there's 4,000. There's not going to be that many more de novos to offset all the acquisitions. Where's that talent going? And so to go grab younger talent that's got upside is out there for you. So again, while we're worried about the smaller institutions right now because of scale, I want to flip it on its head and say, wait a minute, if I can go out and get some of this dislocated talent, doesn't that make me different? And so that to me, you gotta spend some money. Nobody ever wants to write a check, but you're going to have to go do it and work with folks like yourself to say, hey, Brian, who are the 3 best strategists out in the country? I don't care where they worked. Talk to me about those 3 individuals. I will fly anywhere and meet with them. Don't you want someone who shows up at you and says, I want to have breakfast with you. I want you on my team. Here's why. Let's go. That gets me fired up. Sorry, I get excited about this because there's a huge opportunity for the community banking landscape right now around town.
Well, I do want to say though, I've been warning some banks over the last couple of years to not, almost like what you were saying before, when everyone's out there looking for this displaced talent, your story needs to stand out because 2 years ago, before the tidal wave, that's when you needed to be putting those feelers out and trying to get those big fish into your boat. Now, everyone knows that that bank has sold and they know that that talent is potentially up for grabs. It makes it more competitive. 2 years ago, when they weren't sold is when you maybe, should have taken that coffee or tried to kind of urge things forward. So right now, it's really about the storytelling. Like,
that's a great
if you're going to land good talent, why are you better? Where are you going? What's going to be exciting in the future?
I love that. And I tell banks all the time, every bank in the country, every 6 months should go grab 10 people from the community and pretend that they are doing a capital raise. Tell your story. I don't care if you're a $400 million private company. Go get 10 large customers, sit them in a room and show them the 5-page presentation of who you are and who you're becoming. Let them ask you questions, right? Because that's really important. That's who you're trying to get. If you've got 10 great clients, don't you want 20? Bring the 10 in, pitch them your business. That'll give you the playbook, to your point, Brian, to go differentiate yourself, to go get talent. That's the difference I think isn't done enough, is pretend you're public. I say that all the time, even if you're not. And if you are, it's even easier because you're reporting every quarter. Come down with a capital raise to your top 10 customers every 6 months.
Yeah. And this is a great segue because Andrew has been helping a lot of our community bank clients with their storytelling, preparing them. I love that. Pretend you're public. I mean, that's a great, a great little saying there. But Andrew, what are your thoughts on this matter?
Yeah.
And then feel free to ask questions of your own.
Great, thanks. Yeah, we've been talking to some privately held banks, trying to help them improve their slide deck. And we've actually been surprised that there have been more privately held banks that actually want to improve their shareholder communications than I ever would have thought, coming from the public equity side. I didn't know how much of that went on. There's a lot of interest. Now, there's a lot of hand-holding, and a lot of it's pretty basic right now, but there's a lot of interest for some privately held banks to get out and tell their story more. So I guess kind of thinking on the same like growth opportunity for community banks. I mean, obviously, there's some structural advantages that super regionals have. And if you look at the highly rated banks or highly valued banks right now, a lot of those are like the niche specialists, BaaS banks, or they serve a specific industry. But I guess if you look out a few years, who actually is better positioned? Because you mentioned these great opportunities that community banks have by going after this maybe orphaned M&A talent, or orphan talent from M&A. So who do you think is best positioned over the next few years?
I think a couple things. I think a lot of folks confuse sight and vision. I think the best run banks and who can take advantage know who they're going to become and are focused more on who they're going to become, and they can define their new community, right? We talk a lot about community banking 20 years ago. You know, when you talk about community banking, when I first started, it was all about the geography, the local organizations, and that's who started the bank, and that's who we're serving. I think, Andrew, you just brought up a great point. Either you're a super regional or you have to be somewhat niche-y to get a good multiple, right? And look at the M&A deal we announced last week. Esquire bought Signature. They've got a little bit of a niche to them. They trade really well. I know some of the management team. They know exactly who they're serving. They know exactly who they're targeting and going after. So I think, Andrew, you're onto something exactly right. And that's who I would be talking with, private or public. Doesn't matter. If you don't know who you're going to become, who your community really is, I think that's where there can be a disconnect. And I think that's a huge opportunity because you're right. Niche seems to trade well. Now, at the end of the day, trading multiples are nothing more than like interest rate expectations. They're exciting, but they're not usually always accurate. What really matters is, can you deliver consistent you know this better than me. Can you deliver consistent earnings growth, consistent EPS growth over a long period of time and in different interest rate environments, different M&A markets, different capital markets, different regulatory regimes, right? That's a whole different one. And again, I think all of that is so important.
You know, we didn't really touch on the regulatory regime and how it's in theory softer. What are board management, or what are you hearing in boardrooms right now about the regulatory touch now that Trump's been in office for over a year?
Yeah, I think, are you allowed to use the word positive and regulatory in the same sentence? I don't know if I've ever done it before, but
I'll allow it.
Thank you, Brian. I was looking at you to make sure.
Yeah.
But, you know, there is this positive view right now. You've got Mickey Bowman out there speaking everywhere. You know, you got a lot of positives. And I think the proof is in the pudding. I would tell you that, and Andrew, we've seen a lot of this. M&A deals 3 years ago getting announced and closed was like running a marathon. Now it's running a 5K, and I'm going to run another 5K right after this one, right? Look at Huntington. You know, getting those two deals within, weeks of each other is really interesting to me. So it's the time between announcement and close, really powerful. More powerful is I can go buy my B target and still flirt with my A target and maybe get both of those done within the same calendar year. That's a totally different game from that perspective. I would also, though, tell you from a actual exam perspective, I haven't heard tremendous changes. It hasn't gotten a lot easier, and I think that's a positive. I really think we're still dealing with post SVB. How the heck are we supposed to think about our deposits, and how are we supposed to think about contingent liquidity? Those aren't going anywhere because our world has changed so much on the liability side, Andrew, that the regulatory world does understand that that needs more work, more framework, more guidance. So I think hopefully we'll get more of that throughout the next couple of years. But broadly speaking, boards are pretty happy that on the M&A market connected with the regulatory world, there's some really good positives there, which we haven't been able to say for a long time.
Right. Yeah. It's for many years. A lot of times I would hear bank management teams say they can't buy someone because if they're doing this deal, they're not going to be able to. They're not going to be able to buy the one that they really want. So that's great that they're able to buy both A and B and try to get them done even in the same couple of years or the same year. On the contingent liquidity that you mentioned, that's still a big topic in boardrooms and with regulators. So I guess my thinking there, are banks going to be, are they being told to carry more liquidity on their balance sheet? Are they being told to carry higher capital levels? Because we've also seen some management teams and some boards pay off their sub debt with cash on their balance sheet and not have to go out and raise more equity or raise equity or go refi the sub debt at a different rate. Like, well, I guess what's the tone there from the regulators on retaining or maintaining a higher level of liquidity on the balance sheet?
Yeah, I'd say yes and, right? Like, yes, they want us to hold probably more liquidity, more interest rate risk proof liquidity, meaning you can't just tell me a bond that you bought in 2020 is a liquid asset anymore. It's not. It's earning you less than 1% for 4 more years. That's not a liquid asset. So I think one of the best parts that came out of SVB is the fact that we now as an industry need to prove that we have liquidity, right? I always say every single quarter you should price up and talk about an asset sale, most likely a loss, and talk about what it would do to the balance sheet and should we actually do it. And whether you go down the path of executing or not, you've had a great price discovery and discussion with your board and the rest of management. I think that's huge. I think the other thing, Andrew, we're seeing more and more is that it used to be securities were the only area we really sold assets to fill liquidity. You're now seeing loans trade much faster, more effectively, and more efficiently. And I'll tell you, very similar to banks buy other loans that banks originated 5 years ago. The difference today is you've got non-banks putting bids on bank loans when we're selling them. We sold $1 billion triple net lease package from a company in the Midwest, all public knowledge. And when we went out to get bids, we got about 8 or 9 bids. I might not have the number exactly right. We got a lot of bids in. And interestingly, all the bids were not from banks. And a non-bank won the bid. And that's when my head started scratching. Why would a big famous private equity company that everybody knows, why would they care about a loan at 6.5%? Don't they need 20% returns? What I learned, because I'm slow, is I realized that private equity manages a lot of insurance money. You know, insurance companies they want longer duration assets, and these private equity companies can finance it and get more financing and leverage off of it. So you turn 6 to 10. But what matters to my bank is I was just able to prove to my regulators, to my board, that all my pipes and plumbing work, not only on a security, but on a loan that I'm originating at market that I can move at no gain or loss. To have those ebbs and flows right now are really important. And then I would say on the contingent liquidity perspective, the biggest thing I tell every bank in the country, don't write your 38-page contingent liquidity plan that says you're going to borrow money from the home loan bank when everything goes to hell. You can't just do that. You have to have what I call the word when again, right? It's not about going to get money, it's when. And understanding your own balance sheet, loan to deposit, mark to market on your assets, interest rate movements, OCI, all should be a trigger around early detection of when to go get liquidity, right? And having that social media peer group that I've talked to Brian about before in the past is also critical. Make sure you know, whether you want to believe it or not, Andrew, make sure you know the perception of your institution and who other people think you look like. Even if you're like, I look nothing like that institution, it does not matter on social media. We all know perception wins and reality doesn't matter. So know who that group is and follow that group, because the minute there's some negative news on one of them, you might get, thrown out. Bath, baby water, all that. You might get thrown out there. So be prepared and have that in your contingent liquidity plan.
Well, Scott, we're gonna have to wind it down. And listen, the perception on you is that you're somewhat of a genius on the balance sheet game, and the reality is You are. I want to ask one last question to close this down, and it's not bank related.
Uh-oh.
I usually ask about your favorite movie with the Oscars and all that. Maybe that would be a question. I'd love to hear if you have one. But you're a Phillies fan. You're a Philly guy. You love to, you mentioned Avalon earlier. What's one thing that, I don't know, we'd be surprised to learn about Scott?
Surprised to learn about Scott. It's interesting for the amount of traveling and public speaking I do. The thing I love most is to be in bed by about 9 p.m. and not talk to anybody. It's pretty sad and pathetic, but that is one of the things that I think people are surprised. I'll go on a golf trip or something, like, you're falling asleep. It's 8:30. I'm like, this is fantastic. So I'm pretty much a nerd and pretty pathetic. That part you could guess. I think the part you probably couldn't guess is that, believe it or not, I don't want to speak much after work.
Wow. Well, that's okay. I mean, do you think, like, I don't know, Mariah Carey wants to sing when she's at home? No, right? You want to just chill out. I don't know why I thought of Mariah Carey. There's no resemblance, but, it's just, I hear you. Well, we might have to change the title of this to the, like, sad and pathetic Scott Hildenbrand. I'm just joking. That's awesome. You're kind of a homebody. You like to relax.
Yeah.
I can't thank you enough. All these years you've been coming on the pod, on the Travillian Next pod. We're huge fans of yours. Lots of great information in this. Your perspective is always, like, totally of the moment. And I'm happy that Andrew and I could spend a little time with you today.
I love what you all are doing. And it's always great to connect with Andrew. Having worked together years ago. And Brian, just don't get too big for me, right? Always respond to my emails, take my texts. I know you're big time now.
Yeah. Yeah. Lose my phone number, would you?
Your people told me that too.
Well, anyway, thank you again. Love ribbing with you. And wish you a solid 2026 as it goes on. Thanks again for your time.
Thank you both. I really appreciate it.
Thank you, Scott.